If you're in business, there's really only three types of funding. Today's video is going to introduce those three types of funding, and we're going to speak in detail of how they work and it's suitable for your business. Before we get started, I want you to take a second and scan my QR code. It highlights what DIT Capital Advisors does in all our platforms. We're proud to work with every business owner that walks through our doors or gives us a call. Option number one is debt funding. This is the most common way to get capital into your business. Well, what are those capitals? It can be a term loan, which is a business loan. It could be a line of credit, which is short-term money. It could be credit cards. It could be equipment financing. Debt funding is the cheapest, but the most effective way to get money into your business. And why do we say that here at DIT Capital Advisors? Well, we structure debt here. We give businesses money. We did $40 million in 2025 in funded debt transactions, predominantly all through the banking space. Why debt is so important is because you're borrowing X amount of dollars, a certain amount, over a certain period of time at a guaranteed interest rate. So you know your affordability and you know what that predictable rate and payment will be every single month. Debt financing can help you grow exponentially if you use the debt correctly with a strong return on your ROI. So, for example, if you borrow $100,000 at a 10% interest rate, but you're able to use that $100,000 to make 30% year over year, the spread has come to 20%. That's a smart and effective way of how to use debt in your business. So now we have discussed debt financing. Option number two comes down to equity contribution. Well, what is equity contribution? Simply means that you're giving up a percentage of your business to an investor, to a company that believes in your business, that they believe in you, but you're parting ways with your equity in exchange for a capital investment, which does not need to be repaid, but you no longer retain 100% of the business. So there's pros and there's cons to this. Let's start with the pros. One, you don't have to pay back the money that you receive. It goes into the business and it helps expand and grow the operations. That's great. The second thing is that you have the ability to use the money to generate more income for the business and revenues. Now, with that being said, there are some not so favorable things with equity contributions. The biggest is that it comes down to giving up ownership into your business. If you're a small business owner and you take pride in what you have, parting a percentage of your business can be tough. It can mean that if your business goes from $1 million in revenue to $10 million, you just gave up a percentage of that $10 million. Obviously, we're talking about bottom line numbers here, but you have to look at it on the flip side. If that monies that you received in equity contribution when you were doing $1 million scaled your business to 10 million, then it was well worth it. But if nothing changed with that equity contribution and you did it all on your own, but you just changed some systems in place to get to 10 million, and that equity contribution really did not make a huge difference, it's probably not the smartest investment. So be mindful of equity contributions. There's different forms of it too. So we have a chart that we highlight. It talks about selling a percentage of the business with voting rights and without voting rights. Those are preferred and non-preferred voting rights. So understand that when you give up a percentage of your business, you have less voting rights, and those can be converted into shares. All these items that we mentioned are located in certain areas on financials and on tax returns. For equity contribution, it's located on the balance sheet. Look at the chart. We highlight everything here for you to understand. And on the balance sheet, you go on the equity side to see where the equity was brought in from the investors. Keep in mind that equity contribution is an investment into the business. So, third and final one is internal funding. You're probably asking yourself, what the heck is internal funding? It simply means is that the profit that the business generated year over year, which is the retained earnings, is now being used to help grow the business again. What does it really mean? Is that the monies that you have in the bank account that has not been spent over the years, you're using it to fund your business. So instead of going for debt finance through a bank, which is a loan, a line of credit, or to an equity contribution partner who's given you money for an exchange for a percentage of your business, you're doing it all on your own. No bank, no partner. You are the bank, you are the partner. And how? You take the money from your bank account and invest it back into the business. This is the most favorable part of funding option that your business has. You pay no interest for the money, so no debt. You give up no percentage of your business, so no partner. It's the cheapest and most effective way to fund your business. So here's the advantages of it. It's quite simply, it's free money. It's your money. Here's the disadvantage. You're taking all the risk. You have no partner and you have no bank supporting you. So as a debt financing company who gives money to businesses, I strongly believe that internal funding is a great source of funding option for your business. But you need to have a plan of how you're using your money, because you work so hard year over year over year to get here to have healthy profits and have great retained earnings. But if you can't demonstrate how you're going to use the money for the next few years, you just dwindle it all away in a bad investment or a bad choice of use of funds. Look, there are 3 types of funding options that your business will get. We touched on debt funding, equity contribution, and internal funding. They're all located on the balance sheet. They all are either in the retained earnings section, under the equity side, or under the liability side if you're borrowing money as in debt. But there's one thing that all have in common. If used correctly and with a plan in place, they can help grow your business exponentially. It can take you from where you're at right now to where you want to be. But you need to have a system in place to measure you to see if you're doing it the right way. Again, 3 types of funding options: debt, equity, internal funding. You make the choice which one's best for your business. As always, you'll leave as many comments, you'll reach out to us. We're all over on social media, and let us know how we at DIT Capital Advisors can support your business with one of these options. We have over 20 years of experience in lending to businesses and reviewing financials, tax returns, business plans, internal and external documents. There's no big or small deal for us. We're in business of supporting every business out there. Thank you all.